Welcome to The Long and Short of It, a podcast where we take a deep dive into options trading. I'm Patrick Ceresna, your guide to longer-term positioning to build synthetic positions, to structure hedges, and to generate long-term income, all using options.
And I'm Nick Galarnik, where we look at short-term positions that are opportunistic in nature around interesting theses.
Yeah, so together we put a complete perspective on options. So let's dive into this now. Nick, some of our listeners may recognize you as we co-hosted Macro Voices for close to a year and had a great time doing it, and just thought it was an amazing opportunity for the two of us to actually start something that is in our field of expertise, which is we love options. And, the thing is, that was whenever I had this conversation with you, it's like we look at options completely differently.
Absolutely.
And what I'm trying to get out of the options and what you're trying to get out of options, it's neither one of them is right or wrong. We're just literally using the options as a strategic tool to get the outcomes we're seeking. And so we put this together for this amazing opportunity to just share the different ways of looking at the world of options.
Absolutely, yeah. No, I mean, defining a risk and finding asymmetries of risk is really the name of the game for me. And I like finding interesting opportunities that arise out of misconceptions or irrationality in the markets.
Yeah, absolutely. Anyway, let's dive into this. And what we want to do is in each one of these episodes, we want to learn through real application. Everyone out there does these stupid little PowerPoint presentations with, a theoretical position and what happens. But in the best way to learn is actually through looking at the real live markets and how things look. And more importantly, following up how the trade behaved in the future episodes to see what has changed differently, what's been working, what hasn't been working. Was the expected outcome the one we anticipated, whether a losing position or a winning one, but was the outcome that what we expected? So what we want to do is kind of pick apart one strategy. And you decided to take a deep dive right into one of the more advanced strategies out there, known as the butterfly, right? And so why don't you talk us through, first of all, what stock are we going to do this on and why are we going to do it on that stock?
So we're going to look at Google today because recently the DOJ has created an antitrust issue with Google where they've essentially forced them to divest of Google Chrome, the internet browser that's, used by right now, I think it's about 60% of all browsers users are using Chrome right now. So the DOJ has said to Google essentially, you need to get rid of this. You're too powerful and we want you to sell this essentially. So right. Google's stock fell 8% last week from about 176 down to about 165 or so. And as of now,
let me just pull up a chart so we can actually see what that has done. So you're talking about this drop right over here, yes, where basically the stock was trading near about $180. First of all, it had a positive reaction to its earnings back in late October, was trading up in the 180, 185 area for several weeks.
Yes.
And then this announcement basically caused the stock to have this decline. And so we had this drop, temporarily breaking below the 50-day moving average, and now trading right back at that 50 days. So continue what's on your mind in terms of where and how this will play out.
So as you mentioned previously, Patrick, like they had a very strong report last quarter, and right now they're down, about 8%, or they were down at the lows about 8% from the news essentially.
Right.
And right now, my thinking is that there's no one that can afford to buy Google Chrome. So if they're forced to sell it, no one that can afford to buy it will be allowed to buy it. Like, for example, Amazon, Salesforce, Apple, Meta, they won't be allowed to purchase Chrome because it would create the same exact issue. But then the problem here is that they're the only companies that can actually afford to spend about $20 to $30 billion to actually buy this asset outright. So I think it's kind of an interesting situation because I don't think it'll actually transpire. And I think it's also kind of a waste of time to focus on such an innocuous event as this, or topic rather, for the DOJ. So I think it's going to recover back to around 180 or so in the next month, which is why we're discussing a butterfly strategy, wherein we go along about a month out for the December OPEX. I was going to mention the January OPEX, but the problem with that is going too far out in time with the butterfly so narrow doesn't make a lot of sense. You want to essentially pinpoint whatever middle strike you're using, because you're using essentially three different legs in a trade. Like you're going along one strike, so you're buying a call option in this case, the 170 strike, betting on it going up above 170 by expiration. And then you're selling two contracts at the 180 strike with the intention of pulling in more credit to offset your overall debit cost of the 170 strike contract. And then what you're doing is to hedge out your risk, you're buying the 190 strike, which is equidistant in terms of 170 to 180 is 10 wide, and 180 to 190 is 10 wide as well. And so there, you want the stock price to land as close as possible to the middle strike, in this case 180, by the expiration date, which is in this case December 20th monthly OPEX. And so the reason why I'm bullish here is because, well, a few reasons. One is that we should have a rally into end of the year. Secondly, I think it's going to bounce off this decline because I don't see any way that a competitor can possibly purchase this asset for what's a fair price. So from an asymmetry of risk standpoint, by buying this position, and right now the cost is about $2.70, risk to make a maximum profit of $7.30, you have upside of essentially almost 3x right there. And your break-even points are twofold, because in the strategy, you have the risk of it overshooting as well. The risk of it going above all three strikes is the same as it going below the highest strike. So that being below 170, it expires worthless. And above 190, it also expires worthless as well, essentially. So what you want to happen, sorry to cut you off, Patty.
No, but go ahead, finish.
Yeah. What you want to happen is you want it to land as close as possible to 180. And the nice thing here is that it plays on time decay a fair bit, because as the time expires toward the expiration, you're going to see that middle strike dwindle down to almost nothing. And meanwhile, the 170 strike will keep a lot of its premium, and the 190 strike is a hedge, so you don't really care about that at all. So over here, you have kind of a high probability event of making a profit. And what you could do is you could take profit, for example, once it doubles in value, which will require about 2 weeks of time to pass by before expiration. So right now we're November 26th. We're looking at roughly December 7th or 8th or so. At that time frame, if we're sitting around 175 to 180, this position should be trading around $5 or so. And that's when I would take off half the position. If you were to do so, you would remove essentially most of your risk, and then you'd ride the rest into expiration and hope that it lands right near that 180 middle strike, at which point, if it lands smack dab on the nose, which is very, very improbable, you would make a profit of $7.30 on risk of $2.70.
So Nick, let's step back a little bit further, because some people listening to this will want to look at things as to a trade-off, right? And so the first trade-off is, well, why would I choose an option strategy over the stock itself? And so a Delta One stock position, which basically is direct stock exposure, requires a very large amount of capital. 100 shares is going to basically outlay like 17 grand, whatever margin to carry it. And more importantly, an uncertain or undefinable risk, even with stop losses, right? So like just the way that there could be a surprise announcement, some other thing, you could find yourself very easily, again, down another 8% and find yourself, let's say, down $1,000 or something on a stock position. And so somebody who undertakes a stock position is literally just exposing himself as a trader to the traditional stock experience. Now, almost every beginner will then want to simply approach this with simply buying a call option. They'll say, well, listen, I'm just going to outlay a much smaller amount of capital for just buying an outright long gamma call. And I'm just going to, pay $5 buy myself a call option and bet that this stock is going to go to $180. Now, clearly, a butterfly is a little bit more of a sophisticated approach to placing the trade than just buying a call.
Yes.
In your mind, what is the trade-off and the benefit of approaching this with a butterfly versus somebody who just wants to keep it a little bit more simple in buying the call outright?
So in this case, like with every trade, you want to do a scenario analysis and analyze essentially your asymmetry of risk. If you're doing the most simple trade here, and let's say you're buying 100 shares of Google, you're risking about $17,000 right now. If your intention is to sell it at 180, your upside there is $10 profit on 100 shares. It's $1,000 profit overall on 17 grand risk. So the return there would be what, 1 over 17. So that would be 1 over 17 is 5.88%, which is a fantastic return for holding for about a month. Then you go one step forward and you say, okay, well, instead of doing this, I'm going to buy a call option. But if you're buying an at the money call option right now on Google, the 170 strike for the December OPEX is going to be about $500 right now. It's actually
Or
the exact price.
$5, yeah.
Yeah, so it's $5
basically
per contract.
double the cost of the butterfly.
Yeah, double
basically.
the cost. So the problem here is that if we get a big market pullback and Google was like, let's say 165, you could be out, easily $400 or $500 very quickly, right? Whereas if you're using, for example, a call spread where you're buying, let's say the 170 call and you're selling the 180 call, that's an evolution of the strategy where you're defining your risk, but also your reward as well. In that case, you would be risking about, right now, it's about $3.70 to make $6.30. So as you evolve through the thought process of scenario analysis, you get deeper and deeper down the rabbit hole and you say, okay, well, I want the best asymmetry of risk where if I'm incorrect, because keep in mind that even the best traders in the world are oftentimes incorrect pretty often, myself included. You want to lose a nominal amount of money such that it does not affect your overall portfolio returns at all, essentially. So on a shorter term trade like this, you might, for example, allocate 1% or 2% of your portfolio for a 1 month out expiration trade. This is for a margin account, not a long-term investment account. If you're incorrect and so, let's say you stop out for half of a loss here and lose $1.35, let's say you allocated 2% of your portfolio, that's a loss of 1% overall. But let's say that you're correct and you exit at double the value, half the position. Now you've de-risked your entire overall initial investment, and you still have upside of an additional $10 overall. So that's where you can see very, very powerful returns. Again, it's kind of playing on the whole blackjack strategy that Ed Thorpe used back in the 60s and 70s, I believe it was, wherein he would play every hand, counting the cards, but knowing that each hand was not equal in probability of being a winner. So what he would do is he would bet smaller amounts when the deck was not in his favor. And when it was in his favor, he would bet larger amounts up to a maximum of 5% using the Kelly criterion, which was developed by John Kelly at Bell Labs way back when. So it's a betting methodology. It's kind of in opposition to the martingale betting strategy. But the whole idea is that you're risking a small amount of money. And if you're correct, you have a factor of the initial risk as an upside. In this case, you have like 3-to-1 reward to risk. If you're incorrect, you cut your losses at 50%. You take the loss and move on to the next trade. But if you're correct and you get, for example, double your money in advance of the expiration date, you want to de-risk because as it goes profitable, the asymmetry of risk gets worse and worse. Like, for example, you might get in at 270 risk to make 730. But let's say in a couple of weeks, it's at now 380, for example, or $4 risk to make $6 maximum profit, or $5 risk to make $5 profit. At that point, you're risking 1 to make 1. You want to de-risk your position so that you're actually removing some of your risk while maintaining a lot more upside up to a certain point. At a certain point, it no longer makes sense to keep the position on, because if you were to say to yourself, at this juncture in time, let's fast forward like 2-3 weeks, at this moment in time, would I buy this position for $7 risk to make $3 max upside? No. At that point, you say, okay, well, maybe I should close it out entirely, take my profit, and find a better asymmetry of risk trade overall.
Right. So now, the one thing that, in my mind, though, has to be kind of disclosed when looking at butterflies is that, when you're looking at that payoff profile, the one element of butterflies generally is that max profitability can only actually ever be reached at its expiration date.
Yes.
And so I think one of the mistakes that a lot of beginning options traders do is analyze the payoff profiles at end, like if held till maturity, because as traders, we rarely hold a position till its maturity.
That's correct. Yeah.
And so it's about analyzing the payoff structure of the trades under scenarios. If it went down $10 in the next 2 weeks or went up $10 in the next 2 weeks, how would my cost benefit look under those scenarios? And this is something that's very important to consider in butterflies. So, for instance, you shouldn't really, at least in my mind, and you could disagree with me, but in my mind, you shouldn't ever look at the or even envision in your brain the 3-to-1 payoff or whatever it is for the outcome of turning $2.50 into something that's going to be worth 10. The way that this butterfly would be, because you would need the absolute most perfect scenario where
Absolutely.
on December 20th, the stock is exactly at 180, and you might as well be going
4 p.m.
to Vegas. Yeah. You might as well be going to Vegas and just betting on snake eyes on an ongoing basis for that. And so we're using, in this case, at least where I'm interpreting what you're using, the butterfly as a mechanism to participate on the upside of Google, knowing that, like, for instance, something that right now has 3 weeks till its expiration, will maybe in 2 weeks' time, if it's trading at 180, be a double. And so you're going to have a scenario where that butterfly will go from $2.50 to being worth $5, and you made 100% on risk, right? But at the same time, under the circumstance where the stock does nothing or even goes down a little for the next week or two, you're not going to be down $250.
Exactly.
And so you're still actually have a good payoff structure, because you're not going to hold this position for a zero. I mean, there's always the chance that Google has this big outlier move and drops in a rig way and the butterfly zeros. But on balance, that's happens only infrequently. The majority of time, you can manage your way out of the trade quite effectively. What do you agree with what I'm basically saying? You have something to add?
Absolutely, yeah. And I mean, this is where being strategic in your positioning makes a lot of sense too, and like understanding intimately what you're actually doing with the intention of each trade. So, like, for example, with the butterfly, the nice thing is that, as you said, let's say Google pulled back a few dollars in the next couple of days, you have the option, if you wanted to, pun intended, to go ahead and buy back one of the middle strike if you wanted to, because at that point, the 180 strike would diminish in value. You could capture some of that premium if you wanted to, and then wait for a recovery, at which point you'd no longer be holding a butterfly anymore. You'd be holding just a call spread with an additional call, assuming you didn't sell the 190 call, which is your hedge at this juncture, right? Or you could turn it into a narrower butterfly if you want to, for example, or a broken wing butterfly. I mean, I won't get into that strategy because it's very elaborate, but the whole idea is that you want to approach every single trade that you take with an idea of a profit objective, a time horizon, and a directional bias, and then define your maximum risk based upon the probability of that trade transpiring. And as I mentioned previously, based on Ed Thorpe's betting strategy on blackjack, you don't want to be risking large amounts of money based on your portfolio's value in percentage terms over the short duration trades. Like anything less than a month, I would say no more than a couple of percent risk of a portfolio. Anything between 1 and 3 months, perhaps 4 to 5%. And for option trades, really, I don't go past 5% risk in my own personal portfolio. Because again, if you are incorrect, the risk of a full drawdown is possible, especially when you're holding overnight and some outlier move, like you said, happens. You don't want to lose, 10% of your portfolio and have to make up, 11% just to get back to break even again. It's not really a fun thing to do.
Yeah. So what I want to do is quickly share the screen over here. And what I want to also show is how the two strategies carry against each other, comparing a call option to a butterfly. And one of the advantages of the butterfly is generally your theta decay is more or less hedged out. And so what I want to do is, so I here at the Big Picture Trading Simulator have plugged it in. And what I want to show is that if I time decay 14 days off of this option, and we're right here just own a 170 call option. We paid $400 for it, is just what the simulator is showing. And what I want to highlight is if all other things being same, which is volatility didn't change, the price didn't change. So we're just talking about the stock stayed flat for 2 weeks and a little bit up, a little bit down, trading more or less flat. We would have experienced close to like 40% decay of the option premium. Right. And so your $400 outlay would be worth $250 in that scenario. If that number seems small to some of our listeners, just multiply it by 10 or whatever you want.
Yeah.
But the point is that you're down like 40% from time decay. But when I put on the butterfly and I just decay 14 days the same way, all other variables being constant, you're seeing that we're only like down $18, and the $240 is still worth $222. So one of the advantages of applying a more advanced strategy is even the scenario of, well, a lot of times we think a stock is going to do something and then it just doesn't really go wrong, but it just stays stuck. It just kind of grinds. And for someone who's just long gamma, well, that with just a call option, you're paying a very distinct data carry cost, right? Like you're basically, it costs you money to carry it. The butterfly generally carries better and gives you the opportunity to see a couple of weeks of price action and see whether your little thesis or little scenario actually is coming to fruition. Is
Absolutely.
there any other observations or comments you'd make on that?
That's pretty much it. I mean, the only other thing would be that if the time decay kicked in heavily, what you could do is you could roll your position, assuming that your thesis was still intact. Let's say, for example, we're a couple weeks out from expiration and you have, let's say you paid 270, now it's like 240 or 230, for example. You're down like, 40, 50 cents perhaps. And let's say that you still have the same thesis, you could, if you wanted to, roll forward another few weeks to give it more time so that if you're correct, like one of the worst things for me is when you have a thesis and you run out of time and you don't roll it forward and then it transpires afterward. You're like, man, I wish I had 2 more weeks. If I had 2 more weeks or another week, I would have made bank, but you didn't because you just ran out of time, right? So the ability to roll is also nice too, because you salvage that premium. Maybe you pay, 280 again or 270 again, right?
So I want to clarify for those of our listeners that may not know what it means to roll. You want to just think of it that what Nick is saying is we're basically closing the original position and replacing it with a position that is at the new expiration forward. Just at Interactive Brokers, they allow you the ability to make it as a combination trade, basically closing the one and opening the other. You're doing it at a fixed cost. So we call it rolling. But really what you want as a listener to think of is that we're closing the one position, replacing it with another. And it didn't cost us a lot of money to be in the trade for a couple of weeks to see if it started. And then if it's not working, we can add more time. That's a good way to simplify it, Nick?
That's very accurate. Yeah. And the reason being is that with butterflies, typically the more time you buy, the wider you want them to be from point to point. Like you don't want to have a very, very narrow price objective, a half a year in the future, because you're essentially saying, like, let's say, for example, I bet on like a 170, 180, 190 Google butterfly for next June, right? I'm basically betting that Google's going to be at 180 on the mark more than half a year from now, which is a
Yeah.
very, very hard thing to predict. Going out a couple weeks is hard enough. Going out a month is hard enough, but going out half a year is much, much harder. And as you go out further and further, you want to go wider and wider with your legs. And again, it really depends on the volatility skew of the overall positioning based on the pricing of the options for different expiration dates, because different expiration dates will have different pricing based upon binary events that are built in. Like, for example, the election that had a lot of volatility built into it because were there any kind of holdups or questioning as to who won the election, that would cause a lot of volatility in the market. So any options that expired after the election were much more expensive. If you have an earning event, for example, as well, same idea, because there's a binary event that will cause a large movement in the price of the given asset, you're going to be paying more money for the options that expire past that event because you're paying a volatility premium, betting on essentially a binary event causing a massive move in one direction of an asset.
Right. All right. So I'm going to quickly share my screen here. And what I'm going to do is I'm going to, in this sim account here, just place, I'll do it with 10 contracts so that we're talking of some money that's a little bit larger in size. But it's a $2,700 outlay, essentially. Actually, the fill on the sim got $280. So what we'll do is when we get together again in a couple weeks, let's come back to this and actually talk it through. So just to be clear to our listeners, your action points over the next 2 weeks would essentially be to lighten up on the position if there was a double, right? So if
Yes.
we saw a scenario where this option was somewhere near $5 in value, you would use that window. And that would happen if in a couple of weeks the stock was trading near 180.
Yes.
You would be lightening up and taking some profits. And just for clarity for our listeners, where is it that you would decide that to abandon the trade? Is there some criteria that they should be watching for where you would be basically abandoning the trade? What would have to happen for that scenario?
So usually it would be one of three things. Either I stop out based on my predetermined stop loss. So for example, in a position that costs 270, I might say, you know what, my maximum risk threshold is 135. If at any point during the trade it hits 135, I'm exiting for a loss entirely. That's the first criteria. The second criteria would be if, for example, I'm running out of time, we're approaching the expiration date and we're not getting anywhere. That would be a signal to me to either roll it forward, assuming again that my thesis still is intact, or I would cut it and just say, you know what, I'm going to move on to my next trade. And the third scenario that would cause me to stop out would be if my overall thesis changed. Like, for example, let's say that, someone came along and said, I'm going to buy Chrome tomorrow, like Amazon. That obviously means that they're going to be selling Chrome for sure. And it could be a negative for the stock price, in which case it blows up my whole thesis. And now I'm out of the trade because I no longer have a bullish case as to why I'm betting,
Well, listen, we'll follow up in a couple weeks on and just see how the trade developed and how things are looking. The one thing that just to kind of have the conversation before we wrap up today's session, I kind of look at this and it's like, well, who is the type of a trader that would actually benefit from this style of trading? And so immediately my impression, and I'll let you kind of give feedback and see whether you agree, but like usually there are traders that are seeking to be a little more sophisticated than just betting on a stock direction up or down with stocks themselves. And often these types of small capital outlay trades are typically appealing to traders with modest size accounts that are trying to lever up returns to actually make half decent types of percentage returns in their portfolios by using these types of strategies. Like, when I'm like looking at somebody who has a 7-figure account and they're trying to build a portfolio, usually an options trader associated with that kind of amount of capital is looking to use the options for much different outcomes, like managing risk, hedging things out. So this type of a strategy you're describing, what is the typical kind of an account size that someone approaches you with when wanting to do these strategies? And then you did talk about these percentage sizes of like 1 to 5%. So like somebody, he comes in with a 50 grand account, is it fair to say that they would turn around and maybe open, like 4 contracts of this and put $1,000 into the butterfly? Like how, talk us through the way you view it.
That'd be pretty accurate overall. I don't think really account size matters as much. There's a tipping point upon which your capital is so large that you focus more on capital preservation versus capital appreciation. It depends on, again, your cost of living area, what your goals are in life, and as well as what your overall monthly carrying costs to live are, right? Those are all very important variables. If you're living in Thailand, for example, versus living in New York City, huge difference in cost of living. Account size wise, anything less than, I'd say, $1 million or so could apply the same logic to these trades, and they would work pretty well overall. If you're building a smaller account, obviously strong asymmetry of risk trades are where you're going to be able to build it up, because you're starting from a small amount of money. Only way to actually build it up without breaking the bank and blowing your portfolio up is by taking smart risks that offers you incredible reward. So you might look for, out of the money call spreads, for example. In this case, you're doing, roughly 1 unit of risk for 3 units of reward maximum. And ideally, as you said previously, with butterflies requiring to hit the middle strike on expiration, not being a high probability event, you're looking at probably a double up. But the whole idea here is that you're limiting your risk in that in many scenarios, you're not losing money. Like, for example, if Google is flat, you're not losing too much. If it's up a little bit, you're making profit. If it's up a lot, you're making profit. If it overshoots, all 3 strikes, at some point as it passes through the middle strike, unless it gaps up $20 in one day, which has not happened in the past couple of years. Well, it happened once on earnings, I think, for about $15 or so. But basically, in numerous scenarios, you're not going to lose that much money. Yeah. The only scenario you're going to lose, most of your money in this trade, in particular, for example, would be if it were to all of a sudden gap down overnight by like $5 to $7 because we're approaching expiration in the next month or so. Right. So you want to have less risk. Like, again, as I mentioned previously, you want to have less risk based on shorter time frames. So anything less than a month is less than, I would say, 2% ideally, right?
Now, do you usually size the butterfly based on the scenario that it will be max loss of the entire premium, or do you assume that a majority of your butterflies will be exited like at a 50% loss, and so therefore you size the risk off? Like, do you size it based on the actual debit outlay?
Yes, debit outlay, because again, you can't ever foresee what happens overnight. And let's say that tomorrow morning, Amazon says, "Hey, we're buying Chrome," and Google gaps down to like 160, for example, right? At that point, your position goes from 270 to probably around 40 cents. So the whole idea is that you're always managing your risk. Like, you're thinking about your risk more so than your reward. Like, pretty much play back in your mind every trade you take and say, okay, if I were to lose this trade, what would I be comfortable with losing? Based on my current thesis. Obviously, conviction plays a very important role in it too, but conviction only really applies, I would say, in longer term trades, because you can't have such a short term conviction in anything really. You want to look at like even earning events, for example, where people say, oh, they're going to smash earnings. That may be the case where Nvidia, for example, last week, they did very well in earnings, but what happened? They fell from 148 down to like 137 right now. So yes, you were correct in your overall thesis, but the actual market movements did not reflect your thesis at all. And therefore, if you were to bet the bank on that, being a bullish case for Nvidia in this instance, you would have probably blown up a lot of your portfolio, or maybe half your portfolio, depending on what you allocated to that short-term trade, right? So
all right. Well, Nick, we want to keep these to like 30 minutes, so I think this is a great spot for us to head out. But listen, I'm loving this. Having great conversations on options with my good buddy here is awesome, and I'm looking forward to many more episodes of this, bud. So like, I'll tell you what, I'm setting up the trade next time. All right, bud.
Sounds great.
And so we'll kind of share my ideas on there. So anyway, great idea. Let's follow up on it. Thanks everyone for listening. Any closing comments there, Nick?
That's all. Just manage your risk, and that's it. Yeah. See you guys.
By the way, Nick, where can people find you if they're interested in learning more about what you do?
My website is optionfinity.com. That's OPTIONFINITY.com.
Yeah, and you can find me at bigpicturetrading.com. All right. Thanks, everyone. Have a good day. Cheers.